Soaring commodity prices. We've all seen what's happening with food, energy prices going up. Will it push the U.S. economy over the edge next year? Our next guest says rising inflation and rates will send the U.S. in a downward spiral, and there's little the Fed can do to stop it. We're joined now by Euro-Pacific Capital's Peter Schiff. Peter, thanks for joining us on this New Year's Eve.
Thank you, and Happy New Year, guys.
Thank you. Good to see you without the tux, but nonetheless, welcome to the program tonight. What's your outlook for 2011? You're painting a fairly big doomsday scenario by these notes. I mean, everything in here except for the world coming to an end.
I'm not painting it. I'm just seeing it clearly. You know, Murphy's Law is anything that can go wrong will, and there's so many things that can go wrong. One of them is bound to in 2011, and then when one does, it'll be like dominoes. You know, the big problem is the dollar closed out the year very, very weak. I think that continues in 2011. A weakening dollar is going to put more upward pressure on commodity prices that are already rising. It's going to put more upward pressure on interest rates, and it's going to force the Fed to make a very difficult decision. Aggressively start to tighten and let the chips fall where they may, or to try to postpone the pain. They keep on printing, and they unleash an even greater economic disaster.
Peter, exceptionally low for an extended period.
Yeah,
where you been, man? I mean, that's been the quote from the Fed for the last several months.
Yes, that's what they're saying, but as consumer prices really start to move higher, as the dollar starts to tank, as long-term interest rates start to spike, can the Fed really maintain that posture?
Hey, Peter, if we have these higher rates and we have an economy that at least is chugging along, why would the dollar fall apart? If I look around the world, I want to buy dollars. I get a higher rate.
No, the dollar, look, if you throw out the euro.
We had $600 billion of QE come in, and the dollar went up.
No, it went down. You're looking at the euro. I mean, Europe has problems too.
I'm looking at the U.S. dollar went up since QE.
Look, this Australian dollar was up 16% this year. The yen was up 13%. The Swiss franc was up 12%. Gold was up 27%. Silver was up 75%. How do you see the dollar going up? The dollar went down.
Since QE2, the dollar has gone up. You're mentioning those things from the beginning of the year. Yes, it has. Look at the Dixie. Look at the dollar index, which of course is versus the euro. Look at that. The dollar has gone up. The interest rate differentials are changing, particularly with Europe. If you look at the euro two-year rate versus the dollar two-year rate, it's the smallest spread we've seen all year. Things are changing. They don't always have to say.
Let me get Weiss into this discussion. If this was a hockey game, we'll call him the third man in.
The CRB closed the year at a two-year high.
Peter, let me ask you this. In terms of, I don't know how you don't see the euro going lower and the dollar at least holding on or moving higher.
But who cares about
because we're an export economy right now. We're
an export economy. We're running a huge trade deficit.
Yeah, we're running a huge trade deficit with China. In terms of the dollar, though, let me just finish. In terms of the dollar, though, that's where I'd want to be if I were a global investor. You need China to bail out Spain. You need China to come to help bail out Europe. The Germans are getting tired of doing it. The French are getting tired of doing it. You know, UK, they've got their own issues. So you want to buy dollars, not euros.
No, remember, if China tries to bail out Europe by buying euros and buying European bonds, they're going to sell dollars to do it. They can't prop us both. They have to make a choice.
They've got
they want to prop up Europe,
they can do what they like.
Or they want to prop up the U.S. I think they're going to choose Europe and let the U.S. tank.
I don't see that. We're their biggest trading partner.
No, we're their biggest debtor.
I want to ask you, as I mentioned to you before, I congratulate you on your Wall Street Journal editorial on housing. I agree with you, and I think it's very well thought out. And I
number one on the WallStreetJournal.com.
It is a good
Don't butter the guy up before.
Well,
I butter up the caveat here. I know it's coming.
I'm going to disagree with him on something. I agree with you on most of what you say. But if housing is indeed taking a double dip, I think that interest rates actually will stay low. And I guess my question for you is, given the commodities have already surged as much as they have in 2010, and we did not see, now the bond market, yes, it had a bad fourth quarter, but it had a good year. Interest rates are lower on the year. How do you explain that this year?
Well, first of all, what you haven't seen is you haven't seen the commodity users pass on the higher prices that much to the consumer. That's going to happen in 2011, and so you're not going to get these benign CPI numbers when you start to see this pass through. And also, interest rates just started to rise in the last quarter of the year. I think that's going to continue, and so those higher interest rates are going to hurt the housing market because, you know, as rates go higher, housing becomes less affordable.
Kinahan, didn't rates get a little ahead of themselves, though, as they backed up?
Well, not at all.
I don't know. I wouldn't say they necessarily got ahead of themselves, but my question is, Peter, if rates go up in a controlled manner, is it really such a bad thing?
Who said it's going to be controlled? The Fed is not going to have any control over the long end.
So I guess then my bigger question to you would be, where do you see the 30-year rate at the end of 2011 if you think it's going to be kind of uncontrolled?
It could be a lot higher. I mean, I think the rates are going to get towards 4% on the 10-year early in 2010. People might think that's okay. They might think that's the ceiling. But then I think rates are going to spike. I think we can go closer to 5%, and we might even get through that. We even can get to 6%. It's possible before the end of 2011, if not 2012, and then it's off to the races. Remember, yields were at 14%, 15% in 1981. I think we're going to take out that high before the bear market in bonds is over.
Last word. That's it. Thanks, Peter. Good to see you, buddy.
Sure thing.
Happy New Year. We'll see you certainly in the new year. The inflation discussion is obviously great. Peter, of course, is the author of How an Economy Grows and Why It Crashes.